Hi everyone. Today's lesson is about financial literacy. Financial literacy is the ability to understand the language of money. The first thing we're going to learn about is when we take our money and we save it and then we put it in a bank account, we can have either a savings account, which is where we keep our money, and the bank pays us interest. You could also put your money in a checking account, and this is the type of account that you would use to pay bills. It doesn't have very much interest payment or none at all. Interest is the money that is paid when it is borrowed. So banks borrow your money and they pay you for borrowing it. That's what interest is. Let's talk a little bit about interest. Interest is money. When people put money in the bank, they get interest. The interest that is paid by the bank is between 0.25 and 0.75%. So if you're saving money, the bank is paying you about 0.25% in interest. If the bank lends you money, the bank charges you between 3.25 and 16.75% interest. When you borrow money, it's called debt. The bank loves when you are in debt because they make between 3.25 and 16.75% of the money that you borrow. Debt is not good for consumers because they have to pay money to borrow. Let's take a look at the difference between a credit card and a debit card. A credit card borrows money from the bank. So if you purchase something using a credit card, you're actually borrowing the money from the bank to purchase the item. A debit card uses money from your checking or savings account. So when you purchase something using a debit card, you're using your own money. Let's look at some of the good things or advantages to credit cards. If you pay your credit card off at the end of the month, you actually are using the bank's money interest-free for that whole month. You can build your credit rating if you use a credit card, and you can earn points for free stuff because some credit cards give you points for using it. There are some negative things to credit cards as well. If you don't pay off your credit card at the end of the month, you have to pay interest. And if you remember, the interest is very high. For credit cards, it's between 12 and 16.5%. You can hurt your credit rating because you get into debt. You can get into debt very quickly because you can't keep track of all of the things that you buy with your credit card, and then at the end of the month you get this huge bill. Some credit cards actually cost money to use, so that's another negative. Let's look at some of the advantages to using a debit card, which is using your own money to purchase things. That allows you to stay within your budget. You will not likely overspend because if there's no money in the bank account, you won't use your debit card. You won't be able to make the purchase. And it doesn't cost you money, just the money that you're spending on the item. There's no interest. Some of the disadvantages of a debit card is sometimes you need money for unexpected expenses, like say your car breaks down and you don't have the money in your bank account, you won't be able to get your car fixed right away. Whereas if you had a credit card, you would be able to get your car fixed. You can't build a credit rating with a debit card, and you can't earn interest on your money because you're going to spend it as you use your debit card. Let's take a look at checks and checking accounts. Checks represent currency, so they have the same value as the money that is written on them. They're much safer than carrying cash. Sometimes they take time to clear the bank, which can cause some problems. And it also can cause fraud because sometimes people write checks and they don't have the money in their bank to cover the check. And by the time you find that out, that person is long gone. So it's sometimes it can be a risky thing to accept a check. There are fewer and fewer places accepting checks because they're kind of an outdated technology. Checks can be forged, so a person can get a hold of one of your checks and sign your name, or they can give you a check that maybe they stole and you think that it's a legitimate check when it's not. Cashier's checks are like cash, and I'm just going to show you what a check looks like and the parts of a check and the parts that you should be able to understand how to fill out if you ever get a checking account. So the first thing that you do is you have to put a date on the check, and sometimes checks are forgotten or left in a drawer or something, and most banks won't accept checks if they're more than 6 months old. So make sure that as soon as you get a check that you deposit it in your bank account. Number 2 is the payee. So that's a name of the person that you're writing the check to, the person that you're going to give the money to. So the term for that is called a payee. Number 3 is the amount in numeric value. If you take a look at this check, it's done a little bit silly with the little curly thing at the end. I don't recommend doing that. I recommend making your numbers very clear. The number 4 is the amount of the check written in a word value. What I usually recommend is that if something is $8.15, that you write $8 on it instead of 8 and. So write $8. And then the 15 over 100 is the amount of cents, okay? So 15 cents is 15 out of 100 cents. You should always make sure that you sign your name, and you're going to have to practice signing your name so that you have the same signature always, because banks will check your signature to make sure it's yours and that it's not forged. So it's a good thing to practice your signature. And then the last thing you should always write down is in the memo. Tell yourself what the check was for, so that if you're ever looking and you think, geez, why did I spend $8.15 on July 1st? Then you can look and see why you spent it. So this is a really good way to keep track of your spending. The next thing that we're going to look at is we're going to compare buying a home to renting a home. This is a lot of causes a lot of confusion between for people, so I just want to clarify. I'm just going to give you a basic understanding. So when you buy a home, you get what is called a mortgage, and a mortgage just means that you borrowed money from the bank, and that's how much money you borrowed. The mortgage is the amount that you borrow. So when you buy a home, you don't have the money to pay cash for it because some homes are 100 or 200 or $300,000. So what you do is you say, well, I'm going to buy the home, but I'm going to borrow the money from the bank and I'm going to pay it back. And so that is called a mortgage. And let's look at some advantages to buying a home. The first advantage is that you build equity. So real estate and buying homes is a good investment when the economy is in a good state, which is most of the time. And equity is the amount of value that you have. Equity refers to assets, and assets are things that you own. So equity is a good thing. The next advantage is that it's your home, so you can do what you like in it. If you want to paint the walls or change your kitchen cabinets or do some home improvements, put some tile in, those are kinds of things that you can do to improve your home, and you can paint things the way you like it, so that's an advantage. It also provides stability because it's your home. Nobody can kick you out of your home. Well, unless you don't pay your bills and you have to get out of the house because the bank tells you. But the banks are pretty good. You can talk to them and explain that you're having trouble with bills and things like that. And they can work things out for you. But the best thing to do is when you buy a home, make sure that you can afford the payments. It also increases your net worth because when you build equity, that adds to your net worth, how much you're worth. And it's great for your credit rating because if you pay off your bills on time, the credit rating companies say this person is a very responsible person, and they pay off their bills on time. So a credit rating is excellent. There are some disadvantages to buying a home. One of them is that it's expensive. So not only do you pay your mortgage, which is how much you borrowed from the bank. So let's say you borrowed $200,000 and you have to pay, say, $1,000 or $1,200 a month to the bank for the mortgage. You also have to pay the property taxes, the insurance on your home, and maintenance and repairs. So if something breaks in your home, it's your responsibility to fix it because it's your home. It requires a down payment, and sometimes the down payment can be quite substantial, like 5 or 10%, depending on who you borrow the money from. So you have to have a lot of money to start with. The next thing is renting a home. And when you rent a home, it's called a lease. So you enter into an agreement with the person who owns the home, and the person who owns the home becomes your landlord. There are some advantages to leasing or renting a home. You don't have to pay the property taxes or maintenance or repairs. It's the responsibility of the landlord to do that. You can have short-term housing. So let's say you move to an area and you're not quite sure if that's where you want to stay, then you only have to stay for the length of the lease. Most leases are 1 year. You have flexible moving options, so if you decide that you're going to move, you can say, well, when my lease is up, I'm going to move to a new home. There are some disadvantages to renting a home, and these include that you're helping somebody else build their equity, so you don't get any equity when you rent a home. You don't build a credit rating or increase your net worth because you're just giving somebody else the money every month. You can be asked to move out. So let's say a landlord decides that he wants to use his home for something else, then he can ask you to move out. Or after your 1-year lease is up, he might say, I'm not going to re-sign you on the lease, so you're going to have to find a new place to live. Another disadvantage is you can't decorate or make improvements to the home, so you're sort of stuck with whatever the landlord has done to his house, unless you have an agreement with them. And some landlords can be difficult. So those are some of the disadvantages of renting or leasing a home.